Good afternoon, everyone. Thank you so much for joining us today for another one of our WESK webinars. My name is Loretta Haney, and I am a marketing coordinator here at WESK. We are pleased to be joined by Cassandra Whitelaw today. Cassandra is manager of Indirect Tax at MNP LLP. During this webinar, Cassandra will be discussing requirements for GST and PST. Thank you, Cassandra, for joining us today. Please start whenever you are ready.
Thank you very much. So if anybody has any problems hearing me, just let me know in the chat box. So as Loretta mentioned, my name's Cassandra. I work in Indirect Tax here in Regina. And so today I'll be talking about the requirements for GST and PST, starting out and continuing clients. So just to get started, I will give a little bit of background information about the CRA business numbers and some other government registrations that you'll need to be aware of. I will spend most of my time on the presentation today with GST and PST because those are my areas of practice. So for both of those, I will talk about the initial requirements and ongoing compliance. For PST, I will give a general overview of PST in all provinces, but I'll focus mainly on Saskatchewan because that's where we are. So just getting started, there are 4 ways that you can structure a business. There's sole proprietorships, partnerships, corporations, and joint ventures. Sole proprietorships are not considered separate legal entities, and therefore there's no limited liability. These businesses run on the calendar year for their fiscal period. Oh, and sorry, I forgot to mention, if there's any questions as I'm going along, please feel free to type them in the chat box and I'll address them at the end of the presentation. So for sole proprietorships, you'll report the business profits, so the income and expenses from your business will be reported on a schedule in your personal tax return that you need to file every year. The tax return for individuals with self-employment income is due on June 15th. However, the taxes must be paid by April 30th. So even though your tax return isn't due, your taxes will be. If your taxes in the prior years are high enough, then you will be required to make personal tax installments. For individual accounts, if you do need to make tax installments, the CRA will notify you. One advantage of sole proprietorships for tax purposes is that if you have any losses with your business, you can use them against other sources of personal income that you might have. The second type of business is a partnership, and so this is a business between 2 or more entities. It's not a separate legal entity for income tax purposes, but it is a separate legal entity for certain other types of accounts. Depending on how your partnership is structured, any general partners of the partnership will have unlimited liability. If you do have limited partners in your partnership, then the liability for those partners will be limited to their investment in the partnership. So when you start your partnership, you can choose to register your partnership's name with Information Services Corporation here in Saskatchewan. If you're operating in another province, each province does have a similar board that deals with business registrations. So you aren't required to register your partnership, but if you do, the Information Services Corporation will work with the Canada Revenue Agency and will issue your business a business number. If you don't register your partnership, you won't get this business number, but if you do need it, you can apply for it through the Canada Revenue Agency. So as I mentioned, partnerships are not a separate entity for income taxes, and what this means is the partner's share of that partnership's income will be reported on the partner's income tax returns. So if all partners are individuals, this is similar to a sole proprietorship. It's done on a schedule of your T1 return. There are certain cases where additional reporting will be required for partnerships, and this is done on a T5013 partnership financial return. So basically, any partnerships that are considered to be large will need to file these T5013s, and so a larger partnership is a partnership with the absolute value of the revenues and the absolute value of the expenses added together is greater than $2 million, or if the partnership has more than $5 million in assets. Also, you may be required to file one of this depending on the structure of your partnership. So if any time during the fiscal period the partnership is a member of a tiered partnership, if it has corporation or trust as a partner, if it's got investments in certain flow-through shares, or if the Minister of National Revenue has requested the return. A corporation is the third type of business, so this is a separate legal entity. There's limited liability, which means that your liability for the business is limited to your investment. They do have director's liability for cases of willful negligence and and things like that on behalf of the directors. So that is something to be aware of, although generally it has to be something quite negligent. When you start a corporation, it needs to be registered with ISC, and as with a partnership, the Canada Revenue Agency will issue you a business number when you register. And then corporations need to file what's called an annual return with ISC each year, and this gives ISC information about the directors and shareholders of the corporation and that kind of thing. In terms of a fiscal period, corporations can choose any year end they want. So it's good to try and either match this with your business cycle or have your year end at a slower time for the business. For income taxes, corporations file their own tax return, and this is called the T2 corporate income tax return. Tax returns must be filed within 6 months of the corporation's year end, but taxes must be paid within 3 months. So once again, your return is due after the taxes are due. If you've got taxes of more than $3,000 in the previous year, you will be required to pay installments each quarter. However, the CRA does not send installment statements to corporations. The other thing about corporations is those business losses have to stay within the corporation, but they can be carried back to prior taxation years or forward to future taxation years. Joint ventures are not a separate legal entity, and they're not even a complete business necessarily. They're more of a business arrangement. So for this, each member of the joint venture is going to report their proportionate share of everything: revenues, expenses, assets, liabilities. Those all get reported on each venture's financial statements, as well as income tax returns and GST returns. So we won't really talk about a lot about the joint ventures today, just because they're not a separate legal entity. So I've mentioned a couple of times about business numbers. The business number is just what the Canada Revenue Agency uses to identify your business. So most of the time you will get your business number from ISC when you register, but if not, you can file Form RC1 to request a business number from the CRA. Business numbers are made up of 3 parts. So you have the 9-digit business number, which identifies your business with the CRA. And then you have your account identifier, which is an R followed by another letter. And this basically indicates to the CRA what kind of account you're dealing with. So there's a separate account for income taxes, payroll, imports and exports, information returns, and for GST. And then the last part of the business number is a 4-digit account number. So generally this will be 0001, but there are cases where you'll have more than one account number. So for example, with GST, if you've got 2 separate divisions and you track the GST for those separately, then you may want to have 2 separate program accounts under your RT account identifier. The other time we see this a lot is if there's been an amalgamation of corporations, in which case the business number and the RC will stay the same, but they'll be issued a new account number just to indicate to the CRA that something's changed with the business. So the most common types of program accounts, the RC is for income tax for corporations. There's RM accounts, which are for businesses that are importing products into Canada or exporting products outside of Canada. And so this account is used to help process custom documents and help things go smoother at the border. For information returns, there are cases where your business will be required to file an information return. So these are your RZ accounts. So if you have a partnership that's required to file a T5013, as I mentioned, then you'll need to get an RZ account. There's a couple other forms that when they're filed by partnerships, you'll also need an RZ account. Corporations usually need an RZ account if they're paying dividends to their shareholders so that they can file their T5s. And then there are a few other informational returns that the CRA has that you'll need an RZ account for. Then we have the RP accounts. So these are your payroll accounts. Any business with employees in Canada must have a payroll account. You need to register for that payroll account right away as soon as you start paying your employees. And then with that payroll account, you'll make withholdings from your employees' paychecks that get remitted to the CRA under your RP account. So the most common types of source deductions we see are income taxes, Canada Pension Plan, and EI. Certain other provinces do have additional source deductions and withholding requirements. So if you're operating in a different province, make sure you're aware of those. Your payroll remittances will be due on the 15th day of the month following the source deductions, so the period in which your payment was made to your employees, or when you deduct your source deductions from your employees. Even if you don't have any payroll activity, you do still need to file your return. So Canada Pension Plan, CPP, is made up of two components. There is the employee contribution, which is withheld from your employees' paychecks. And then there's the employer contribution, and both of these amounts need to be submitted under your RP account. EI is very similar. There's an employer contribution and an employee contribution. If you do happen to be a self-employed individual, for Canada Pension Plan, you will be responsible for making both the employee and the employer portions of the contributions. For employment insurance, you can choose whether or not to pay EI for yourself as a self-employed individual. But if you do decide not to pay, that could affect your eligibility to claim it in the future if you need to. Another registration that you need to be aware of is the Workers' Compensation Board. So every province has its own WCB. Generally, if you have employees working in a province, you'll need to be registered with that province's WCB, but do check the requirements prior to registering. If you fail to register when you're required to be, there can be serious implications. You can have fines. You may be responsible for the employee's compensation payments, and you may have to make payments for prior years that weren't made. If you've got employees in another province, you'll want to check out that province's WCB as well, because there are certain situations where an out-of-province business may need to register with WCB. So obviously this isn't an all-inclusive list of requirements. There could be other kinds of registrations depending on where you're operating, what type of business, the municipality that you're in, and those sorts of things. So it is important to consult any business legislation in your region, and government websites are a really good tool to use for your requirements. Some other things to keep in mind would be any environmental obligations, zoning restrictions, that sort of thing. And the other thing that you really want to make sure is that you have the appropriate level of insurance to cover your business's needs. So now we'll get into the goods and services tax and the harmonized sales tax. So back in June, I did a webinar for WESK on GST and HST, and that webinar goes into a lot more detail. So I'll just kind of touch on things in a high level in this webinar. And if you want some more detail, please feel free to refer to the other one. I believe it's still posted online. So GST and HST are essentially a tax on the supply of most goods and services in Canada. GST is either at a 5% rate or a 0% rate. Then for provinces that have HST, so this will be Ontario, Nova Scotia, New Brunswick, Newfoundland, and Prince Edward Island. These provinces have harmonized their PST with the GST, so their provincial sales tax is included in the harmonized sales tax, and it's administered by the federal government. So you make all your remittances and all your payments and all your filings to the CRA, and then the CRA sorts out the provincial allocations after the fact. So you need to be registered for GST if you are providing a taxable good or service in Canada and you do not meet the small supplier threshold. So the small supplier threshold provides an exemption from GST registration if your sales in the preceding 4 calendar quarters are less than $30,000. If you exceed $30,000 worth of sales in those 4 preceding calendar quarters or in a single calendar quarter, then you are required to be registered for GST. GST is conducted under the RT program account, and HST registration occurs with GST registration, so there's no need to have a separate account for both. They're all administered through the Canada Revenue Agency. So throughout this presentation, I may just say GST, but if I say GST, I'm also referring to HST. It'll depend on the province that you're in, which will apply. Even if you are under the small supplier threshold, you can still choose to voluntarily register for GST. The advantage to this would be if you've got a lot of startup costs in your business but earning a lot of revenues, because you will be able to take a credit for the GST paid. If you are registered for GST, then you have to charge GST on your supplies until you cancel your registration. If you register voluntarily, you also have to remain registered for at least a year. So in order to determine whether you need to be registered or not, you need to figure out what kind of supplies your business is making. So for GST, there's two types of supplies. There's taxable supplies. So these are taxed at a tax rate of either 0 or 5%, or 13 or 15% if you're in an HST province. With taxable supplies, you are able to claim any GST back on inputs that you've purchased to make those supplies. The other type of supply is an exempt supply. For these supplies, GST and HST do not apply. However, this also means that you can't claim any credits for GST that you paid in providing those supplies. So most goods and services will be taxable at either 5% for the GST provinces or 13% or 15% for the HST provinces. And so some common examples would be commercial real property rentals, sales and leases of automobiles, professional fees, accommodation in hotels, any commercial real property, as well as any newly constructed residential real property. So there are also some goods and services that are taxable at 0%. These are known as zero-rated supplies, and the reason why the CRA has this in their GST legislation is to essentially relieve the consumers from having to pay GST on those items without penalizing the producers by not allowing them to get their taxes back. So for these, they're taxed at 0%, but you are still able to claim input tax credits. So these are things like basic groceries, agricultural products, prescription drugs, medical devices, as well often things that are taxable when sold in Canada. If you're directly exporting them outside of Canada, those may fall into the zero rating provisions as well. So then the last category is exempt supplies. So these are things such as used residential housing, long-term residential accommodation, the majority of your health, medical, and dental services, although cosmetic services still remain subject to GST. Insurance policies and most services provided by financial institutions will also be exempt from GST. And so once again, no tax when you're billing your customers, but also you can't claim the input tax credits. So once you've determined that your supply is taxable and not zero rated, then you need to determine whether you're charging GST or HST. And so to determine that, they look at what's called the place of supply rules. These are fairly complex, so I'll just kind of touch on them at a high level here. But they are based on the type of supply that you're making. So with tangible personal property, if you sell goods in a province, so like in a storefront or something like that, or if you're delivering goods to a province, then the sale of goods is deemed to be made in the place where the goods are either delivered or made available. For leases, it depends on the length of the lease term. Any leases that are less than 3 months will be based on where the supplier makes the leased property available. For leases that are greater than 3 months, it's going to be based on where the property is ordinarily located. So if you rent something in Ontario, but you've used it exclusively in Alberta, then you'd be charging GST because it's determined to be in Alberta. And this is redetermined on each lease interval. So every time you renew your lease, you have to look at where the property is ordinarily located. Real property, the rate of tax is going to be determined by the province in which the real property is situated. So for sales of real property, the reporting of these is a little bit different. If the purchaser is registered for GST, then they have the responsibility to report and remit that GST on their own GST return. If they've bought the real property exclusively for commercial activities, they may also be able to claim an input tax credit to offset this cost on that same return. And so the reason the CRA has done this rule like this is to kind of mitigate cash flow issues rather than having to pay the GST and waiting to claim it back. You can just do it all in one return. Services get very tricky for GST. They've got 4 general rules, but there's over 18 exceptions to those rules. So if you are providing services, you'll want to look at your specific service to determine which of these rules it falls into. Often the CRA will look at the contracting address as the place of supply, but as I mentioned, this isn't always the case, so you do need to be very careful with services. So I've referred a couple of times to input tax credits. So anytime you purchase something for your business that's going to be used in the provision of a taxable supply, you may be eligible for an input tax credit on that, and so you can basically recover any GST that you've paid. So if you have acquired something to be used 90% more in your commercial activities, you're eligible to claim the full ITC. If your use is 10% or less in commercial activities, then no ITC can be claimed. And between 11 and 89% in taxable activities, then you can claim a partial ITC. And then this will be based on the percentage of business use. There are certain types of expenses where the ITC is limited. And once again, you can't claim ITCs on purchases made for exempt supplies. Capital property is a little more cut and dried than your operating expenses and your real property rules that we were just discussing here. So with capital property, if 50% or more of the use of that capital property is going to be for taxable activities, you can claim the full ITC. If it's 50% or less, then you can't claim any ITC at all. So as I mentioned, there's a few limitations on ITCs. These are just some of the biggest ones that we see. They parallel the income tax rules for most of them. So for meals and entertainment, you can only claim 50% of the GST paid. There's certain rules regarding home office expenses. You may be eligible to claim some ITCs if you have space in your home that's used primarily for business. If you purchase a passenger vehicle with a cost that's greater than $30,000, you may have a limited ITC claim available depending on the type of vehicle and the amount of business use. And things such as golf dues and club memberships, just like with income tax, there's no deduction allowed for those type of items. If you're running your business for a while and then register for GST, if you have any capital property on hand, you are able to take an ITC for that property at the time of registration. That'll be based on the fair market value of the asset at the time that you register. If you have any prepaid expenses, then you can claim an input tax credit for those, but you're not able to claim any input tax credit for expenses that have already been consumed in your business. So registering for GST is fairly easy. It can be done many ways, over the phone, in person, by mail, by fax, or online. So if you want to register for GST, use the same form as you would to request a business number, Form RC1, although you don't have to fill out as much of the form. It is the same form. When you register for GST, you'll need to decide how often you want to file your GST return. So based on the annual sales of the business, the CRA does have filing thresholds and automatically assigned reporting periods, but you can elect to file more frequently. Just be aware that the more you have to file, that means the more GST returns you have to do, and so there is a little bit more of an administrative cost. So if your annual sales and revenues of you and any associated businesses are less than $1.5 million, the CRA assigns you an annual reporting period, but you can elect to file more frequently, so monthly or quarterly. With revenues between $1.5 and $6 million, the assigned reporting period is quarterly, but you can elect to file monthly. And if you and your associates have more than $6 million in taxable sales, then you must file monthly. So when you file your GST return, GST returns are filed based on the net tax method. So to calculate your net tax, you take all of the GST that you have collected or has become collectible during the period, and then you can offset that with any GST that you have paid on taxable supplies. So these will be your ITCs. And then there are a few other adjustments that might come up. So for example, bad debts. And then the net taxes owing or refundable is essentially the difference between the amount you've collected and the amount that you've paid. You can file your return and your remittance either by mail. You can also do this through a financial institution, such as a bank, or you can do your return and payments electronically. My preference, if you can, is to file electronically because it's quick, it's easy, and you get a confirmation number right away showing that your return was received. So when do you need to file? For monthly and quarterly filers, the GST return and the payment are both due a month after the end of the reporting period. For sole proprietors who are annual filers, so these are going to be individuals with a December 31st year end, the GST return and the payment are due at the same time as your taxes. So this means that the tax return is due on June 15th, but the payment is due on April 30th. For annual filers, both the return and the payment must be filed 3 months after the end of the fiscal year. If your GST payable in the last year was greater than $3,000, you will be required to make GST installments on a quarterly basis. And once again, this is something that you'll have to track yourself. The CRA doesn't send notices. So the CRA will charge penalties on interest on any amounts of GST that are outstanding past due dates. So that's any late remittances of net taxes owing, late or insufficient installment payments, or any other GST amounts that might be outstanding. Something to note is that payments to the CRA are not considered received until they're actually physically received. And so this means that the postmark date is not considered the date that the payment was made. It'll be the date that the payment actually makes its way into the CRA's hands. Also, if you need to make a payment to the CRA in excess of $50,000, you must remit that through a financial institution. When you collect GST, you need to let your customers know, and this is important so that they can claim their ITCs if they're eligible. So the amount of information required to be disclosed on your invoice will vary depending on the amount of the sale. Obviously, a larger sale will require more disclosure. We generally recommend if you're using an accounting software or something like that, I would recommend just including everything on the invoice, and that way you don't have to keep track of how much the sale was and what you've got on your invoice. They've just all got everything that you need. You can cancel your GST registration depending on what's happening in your business. So if you close down your business, or if you've sold a particular part of your business, if you've stopped making taxable sales, or if you've registered as a small supplier, you've been registered for at least a year and you're still not required to be registered, you can cancel your GST registration. This can be done either by calling the Canada Revenue Agency or by completing Form RC 145. Something very important to keep in mind about canceling your GST registration is that when you cancel that registration, there's what's called a deemed disposition of any assets that you still have in your business. And so essentially you're deemed to have sold these assets to yourself at fair market value. And so what this means is you will have to remit GST on those assets. However, you're not eligible to claim an input tax credit because you've now canceled your GST registration. So depending on the assets in your business and their fair market values, there could be a GST cost to canceling your registration. I've just got a slide here with some common deficiencies that we see. Probably one of the biggest ones is the incorrect handling of taxable sales of real property. These rules can be very complex, and so we often see things getting missed or being done incorrectly. We've also seen in an associated group where the wrong company is trying to claim the input tax credit or refund. Another thing that's really big that we see is that a vendor hasn't put their GST registration number on their invoice. So in order to claim the input tax credit, you do need that information. And then just a couple of other things, processing errors, correcting invoices, and as well any failures to self-assess GST. So there are certain circumstances where if you've changed the way you're using an asset, you may have to pay GST. And so we often see those get missed. So now getting into the provincial sales tax. So provincial sales tax is a tax on goods and services purchased within a province. There's currently 3 Canadian provinces that have PST. These would be Saskatchewan, Manitoba, and British Columbia. As I mentioned, most of the provinces have harmonized their PST with the federal GST, so you don't really need to worry about that separately. It's all taken care of with the GST and HST returns. In Alberta and the territories, they don't have any provincial sales taxes, so all applied there is GST. Quebec does have its own provincial sales tax, but it works differently from the other 3 provinces that have it. So Quebec's sales tax is called QST, and it's a 9.975% tax on the selling price. This is administered by Revenue Quebec. The QST legislation generally tends to follow the GST legislation. And so if you are making taxable supplies in Quebec that exceed $30,000 in the preceding 4 calendar quarters or a single calendar quarter, you'll be required to register for QST. In addition, there are certain things that regardless of the amount that you sell, you have to be registered. So these are things such as tobacco, fuel, alcoholic beverages, tires, and road vehicles. As well, if you're selling admissions to the public for activities or events occurring in Quebec, you will also need to be registered for QST. Revenue Quebec is working on changing their QST rules right now. Essentially, they want to target electronic commerce. And so previously, businesses in Canada which were registered for GST and were not carrying on a business in Quebec, nor did they have a permanent establishment, were not required to be registered. Now, if they reach that $30,000 sales threshold, they will be required to be registered for QST in Quebec on the sales of any taxable goods, intangibles, and services to customers. So if you have customers in Quebec, you'll want to make sure that you're familiar with these new rules. So the 3 PST provinces, their legislation is reasonably similar, although there are definitely some significant differences. So what I'll do is I'll talk about some commonalities between all of the PST provinces, and then I'll finish up with some discussion about specific things to Saskatchewan. So in all the provinces, PST is what is considered a consumption tax. And so the purpose of this is to tax the consumer or the end user in a supply chain. So the consumer or the end user is considered to be a purchaser who has purchased the taxable goods or services for either their own use or consumption in a province, or if they're going to be using those taxable goods or service to provide another taxable service in a province, or if they're going to be providing promotional distributions in a province. So PST applies anytime taxable goods are purchased in a province or shipped to a province, or anytime taxable services are consumed in a province. So this means that the purchaser doesn't need to be a resident of that province or even a resident of Canada to be subject to PST. With PST, the seller is the one that has the obligation to collect and remit the tax. However, unlike with GST, with PST, the liability for tax actually rests with the purchaser. So if your supplier has failed to charge PST when they should have, then you as the purchaser are on the hook for that PST. So with PST, we see a lot more self-assessments than we do with GST. There's several instances where purchasers will be required to self-assess on goods and services obtained in a province. So if you import goods into a province, either on a permanent or temporary basis, you'll need to self-assess tax on those goods. As mentioned, if the seller fails to charge or collect tax, then you need to self-assess and remit that tax on your own. If you purchase business assets as part of a business sale, you'll also need to do a self-assessment. Or if you've purchased any inventory on a PST exempt basis and then started to use it within your own business, you'll also need to self-assess on that. So in terms of registration requirements, basically anyone carrying on a business in Saskatchewan, Manitoba, or British Columbia will be required to be registered for PST in that province. Carrying on a business generally involves selling or leasing taxable goods within a province, selling accommodations in a province, providing legal services in a province, or providing services related to taxable goods, software, or telecommunications services. Even if you don't operate out of a province, you may be required to register for that province as PST. So if you're selling taxable goods in a province, delivering them to a province, accepting orders originating from a province, or if you're soliciting orders in a province, you'll still need to charge PST, even if that's not where your business is located. Soliciting orders generally involves direct targeting of certain provinces. So if you've just got a website that's open to anybody, can be accessed throughout the world, and you're not specifically targeting a province, then you don't fall into the soliciting orders rules. Each province does have a small supplier threshold, but they're pretty restrictive and hard to meet. So in each of the 3 provinces, if you have annual sales of less than $10,000, you may meet this threshold. Saskatchewan's requirements are a little bit tighter. Not only do you have to have sales of less than $10,000, you also have to operate your business from the home, and the goods or services must be sold to other individuals on a small scale or non-commercial basis. So it's pretty hard to meet these requirements. If you do meet these requirements and don't have to register for PST, just note that you must pay PST or self-assess PST on all inputs that you've consumed in the province. So Saskatchewan's PST rate is 6%, Manitoba's 8%, and British Columbia is 7%. On the slide here, I've got the websites for the provinces. These websites are actually a really good resource. They have lots of bulletins regarding the taxability of certain items. They also have access to all of the forms you need and go through the registration requirements and everything. So those are very useful websites. In each of the PST provinces, if you have purchased a good or a service for resale, then you purchase that exempt from PST by providing the vendor with your registration number and informing them that the purchase is for resale. And the purpose of this is just to tax that end user or consumer and not have tax elsewhere in the supply chain. Anything that your business uses to provide a service or another good, so basically what you consume, will be taxable to you. And so it's important to distinguish when a service is resupplied versus when it's acquired for your own use or consumption. Subcontractors can further complicate the issue, so you need to look at the entire supply chain, not just your component of it, and you also need to look at what the services are for. So now we'll get into Saskatchewan's PST a little more specifically, and we'll talk about kind of what you need to be aware of Saskatchewan. So all businesses in Saskatchewan must be registered for PST unless they meet that small supply threshold. Any non-resident contractors that are carrying on business in Saskatchewan must register for PST, regardless of whether their services are taxable or exempt. For PST, when you register, you obtain a license number, and you need that to collect and remit the PST. There are very few circumstances now where you won't have to register for PST, and any registration forms are all posted on the Government of Saskatchewan's website. So with tangible personal property, in Saskatchewan, tangible personal property is taxable unless it's exempted. There are certain exemptions for farming and certain other items, but there aren't a lot. The definition of tangible personal property is pretty broad. It includes any new or used property. It does exclude real property. So tangible personal property is basically anything that's perceptible to the senses. So this will also include data and information, which kind of targets electronic commerce. So as I mentioned, you can purchase inventory PST exempt. And with inventory, you do have 2 kind of ways to deal with it. So you can purchase it exempt, and then if you take any of those items from inventory and use them in your business, then you can self-assess at that time. Alternatively, if you find that you're buying more of your inventory for use in your business and only reselling a few things, then you can pay PST on all of your inventory purchases and take a credit on your PST remittance for any inventory that you've resold. Whichever way you do it, you're going to want to make sure that you have a good record-keeping system and that everything's documented. In situations where you've manufactured an item for your business's own use, then on completion of that item, you will need to self-assess 6% of any costs relating to that item. So that's your direct costs, labor and materials, as well as any overhead allocations. Consumables are what is acquired but not for direct resupply. So these are things such as tools and equipment, office furniture, computers, software, and any inputs consumed but not supplied. So with these, an example of an input consumed but not supplied would be if in a situation where you've hired somebody to paint your wall. The paint is something that you now take ownership of. It's on your wall. And so that is a resupply. However, any paintbrushes, paint rollers, tape, anything like that, the consumer doesn't actually take possession of those. They're just used up in the provision of the service. So those are what's considered consumables. And with consumables, you need to pay PST on any consumables that you've used in your business. In terms of intangible personal property is generally not taxable in Saskatchewan, so this will cover your consumer list, goodwill, trademarks, copyrights, all that kind of thing. It is still considered personal property, but it falls outside the definition of tangible personal property. Then with real properties become a little bit trickier now that there have been some changes to the PST legislation. Real property is essentially land or buildings or any property that's permanently affixed to those land and buildings. So any sales and leases of land will be exempt from PST. Any leases of buildings are also exempt. However, sales of new buildings will be taxable. Sales of used buildings still remain exempt, but new ones are taxable. If you're selling land with the new building, you'll need to allocate the cost between the land and the building and charge PST on the portion allocated to the building. This valuation could be challenged under audit. And any services that are performed on real property will generally be taxable. So services to real property are considered to be something that changes the real property. So whether it's constructing, remodeling, renovating, improving, that kind of thing. There are some certain limited exceptions, and the PST will apply on the entire charge for the service. So that'll be the labor, overhead, profit, the entire amount. Any services that are less significant to actually changing the real property will still be exempt. So these are things like lawn maintenance or snow clearing. Road grading is a pretty interesting example because if you're building a road, you're changing the land, and so therefore the road will be taxable. But if you're just maintaining the road, keeping it going, that sort of thing, that's exempt because you're not actually changing or altering the real property, you're just maintaining it. So it's a little bit like the difference between a capital and an operating expense in that way. If you're in the business of land development, you need to be aware that you're considered to be the consumer of any taxable goods and services in relation to the land. So that would be things such as installing utilities, excavating the land, and that sort of thing. So you will need, the developer will bear the PST cost for those items. So then, aside from services to real property, we have services in general, and so obviously these have a very large impact on businesses. With services, unless they're specifically designated as taxable, they will be exempt from PST. This can be a pretty complex area to navigate just because services is not a defined term, and it's very important to properly characterize the type of service. Need to properly characterize the type of service so that you know whether or not you need to pay PST on it, because as I mentioned, you will bear the cost of the PST if you miss it. Can everybody still hear me okay? Okay, perfect. Excellent. All right, I'll continue on. So in regards to PST, for taxable services, these are all laid out on the Government of Saskatchewan's website in one of their PST bulletins. Some of the main ones that we see a lot would be accounting, bookkeeping, any computer programs and services, legal services, real estate services. Any repair or installation services related to tangible personal property will be subject to tax, as well as services to real property. General consulting and advisory services can get a little bit complex. They will be exempt unless they're included in the sale of taxable goods and services. So essentially, if you're just billing for consulting, that'll be exempt from PST. But if you're billing for consulting and bookkeeping and all that as one charge, then that becomes taxable. Training services will also be exempt unless they're a mandatory part of the sale of taxable goods and services. It is kind of hard sometimes to tell between intangible personal property and services, especially with computer services. So if you are offering either of these, just take a look at the bulletins and make sure that you've got your service classified correctly. There are some exemptions for PST, mainly in the fields of agriculture, production and manufacturing, exports outside of a province, and purchases for further resale. So when you calculate tax, it's essentially 6% multiplied by the value of the supply. Generally, the value of supply is going to be the sales price. If you do have to do a self-assessment, you're going to calculate PST on the laid down cost, which includes the purchase price, transportation charges, customs and excise duties, and importation charges, but it does not include the GST. So with taxes, duties, and levies, for the most part, these are going to be subject to PST. GST will never be subject to PST. If there are environmental handling fees that have been imposed by the government of Saskatchewan, they won't be subject to PST provided that they're segregated on the customer's invoice. Taxes payable at the time of the sale, so the seller is required to collect and the purchaser is required to pay. If the seller does neglect to collect the tax, then the purchaser needs to do that to self-assess the tax in their next PST return. In terms where you've refunded a customer for an item, you'll refund both the purchase price and the PST to the customer, and then you'll take an internal adjustment when calculating your PST remittance and reduce your remittance by the amount of the refund. Bad debts are similar. You remit the tax at the time of sale, and then once you have documentation proving that the debt has gone bad, you can take another internal adjustment and reduce your next PST remittance by the amount of the bad debt. If you bring products into Saskatchewan, you will need to do a self-assessment. If you're bringing them into the province on a permanent basis, you'll calculate tax on what is called the depreciated value method. So you basically take the tax rate times the depreciated value. You're allowed to take 1.5% per month, starting with the original purchase price, up to a maximum of 60% to get your depreciated value. If you're only going to bring an asset into a province temporarily, then there's a different method to calculate it, and it'll depend on whether PST is paid in a different jurisdiction or not. If PST has been paid in another jurisdiction, each month you remit 6% times 1/36 of the purchase price. There's no deduction for trade-ins or depreciation, and you do this until you've done it 36 times, so until the entire amount of tax has been paid. If PST has not been paid in another jurisdiction, it's fairly similar, only you remit 1/3 of the purchase price times the tax rate for each year or part year until 3/3 of the tax is paid. So you can file your PST returns online, which is a convenient feature. PST returns will be due by the 20th of the following month. On your PST returns, unlike GST returns, you can't actually create a refund. You have to make sure you're reporting your tax on your retail sales and any other taxable sales, as well as your own consumption. Audits can happen with PST, and if the audit goes wrong, there are appeals in courts available. So if you wind up under an audit, then interest and penalties will, interest will apply on all taxes and penalties owing. So the normal audit penalties will be 10% of tax assessed if you completely missed it, or if you've collected tax but not remitted it, it'll be a 25% penalty, unless you've willfully failed to remit, in which case the penalty will be 100% of the tax assessed. So just to wrap up, I wanted to make a note about record retention. So this isn't just for PST or GST, this will be for anything to do with your business. It's crucial to keep records. The CRA requires that businesses keep their records for 6 years from the end of the year to which they relate. So that means that at any given time, you'll have 7 years of records on time, the prior 6 years and your current year. The CRA can ask you to keep your records for longer. You are able to make a written request to destroy your records before the 6-month period or the 6-year period is over. And then the CRA has discretion whether to allow that or not. And with the provincial finance bodies, as well as with the Canada Revenue Agency, they do have the right to audit your records. So it's very important that you've got everything clear and organized. All right, so that's all I've got for you today. I see there's a couple of questions, so feel free to post anything else that you might have thought of. So we have one question that says, is it necessary to register a sole proprietorship with Information Services Corporation? And if not, what is the advantage to doing so? So it's not a requirement to register your sole proprietorship, but what you can do is if you register your sole proprietorship, then ISC will actually reserve the name for you. So if you go to incorporate in the future, you can you can have an easier time getting that name that you want. But otherwise, really registering a sole proprietorship name isn't overly advantageous. But it doesn't hurt either. There's no filing requirements or anything. It just gets your name on file with ISC. And that's, okay. So then the next question is it necessary to charge PST on used items sold at less than $300? So that's a really good question. PST for Saskatchewan does have that $300 exemption. So you don't need to charge PST on the first $300 of that used item. All right. So if you're running a business already and then register for GST later, the question is, do you start charging and remitting GST on the registration date? So yes, that's correct. As soon as you're registered for GST, you need to start collecting and remitting it. Another question is, do you have any recommendations on finding bookkeepers? I don't really have a lot of recommendations in terms of selecting a bookkeeper, but it would be helpful to kind of check out their qualifications. Some people may have an accounting designation, others may just have a certificate or a diploma or a degree. So I would check out the qualifications of your bookkeeper and also their industry experience. So if you, for example, if you have a farm, you may want to find a bookkeeper that specializes in farm bookkeeping. So the next question is, when a company is pre-revenue but has registered for GST, do they need to report it monthly? So if you're registered for GST, you do need to file a GST return for each period after you've registered. So depending on how you've set up your GST registration will determine how often you have to file your return. But you do have to file a return for each period after you register, even if there's nothing on it. And so then we've got another question about, do you pay and remit the GST starting on the sale that put you on the $30,000 mark? So once you hit the $30,000 mark, you actually do have what they call a 1-month grace period. So after you've hit that $30,000, you have a month to get registered for GST, and then from the registration point onward is when you start to charge it. Okay, so we still have a couple minutes left if anybody else wants to squeeze any questions in. Okay, it looks like that's it. Thank you everybody so much for your time and for coming to listen to me talk, and I hope you all have a great day.
I would like to give a huge thank you to Cassandra for sharing some great information with us today. I also want to say thank you to everyone who was able to join us on today's webinar. You will be able to view this webinar on demand on our website within a few days. Our next upcoming webinar will be on February 12th, and it's called Intellectual Property Save Your Assets. This webinar will be presented by Corey Furman of Furman IP Law and Strategy. Registration on our website will be open soon. Stay tuned. Bye everyone, and have a great afternoon.